Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Good afternoon, Michael. Certainly got a lot to get through today.
Indeed, yeah, very good afternoon to you, mate. It's been another busy week. We're only 2 weeks into 2026, but it feels like about 2 decades worth of stuff has already happened, I think.
Yeah, I mean, where to start with all of this? I think,
Well, I was hoping you'd tell me,
yeah.
to be honest.
Well, obviously, geopolitics is front and centre. We've got Greenland now, the focus, following on from Venezuela last week or the first 2 weeks. President Trump turning his attention slightly more eastwards, shall we say. He's also taken aim at the Fed as Mr. Trump and Jerome Powell with this Department of Justice subpoena. And he's also had a pop at US banks with a 10% cap on credit card fees threat. So I'm going to be talking an awful lot about all of that, what that means for markets. Markets don't seem overly concerned about it at the moment, judging by what we've seen thus far with the FTSE at record highs, the S&P's rebounding again, still below the record highs, but still looking reasonably buoyant. So yeah, I mean, quite a bit to get through, and that's before we even start to talk about some of the data that we've seen out of this week from the US, the UK, and the earnings announcements.
Yeah, absolutely. And I mean, I must admit, obviously, the news of those Department of Justice subpoenas at the Fed broke, Sunday night, very early Monday morning here in London. And I certainly didn't expect the market to have, pretty much entirely moved past that and shrugged it off by, where are we now, sort of early Thursday afternoon. It's quite remarkable how quickly the market seems to have jumped from one narrative to another over the last 4 trading days or so, but also quite remarkable at the same time how resilient and how robust risk assets have continued to be.
Yeah, absolutely. Before we get to that, going to have to address some feedback we got from last week's podcast from a listener who claimed...
Well, should we do the risk warning first?
Actually, yeah, that's a good idea. Let's do the risk warning first.
Otherwise, we'll get in even more trouble.
yeah, let's do the risk warning first. Okay, so the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 71.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay. So obviously before we get to the topics of the day, and there are quite a few, so what I'll actually do is I'll probably go through the topics and then regular listens, if they want to then skip ahead, they can.
That's a good idea.
While we sort of deal with the with the matter at hand. So obviously we're going to look at what's driving markets this week. So obviously Greenland, Venezuela, the DOJ subpoena. What is Trump thinking? That sort of thing. We'll talk about UK markets, highs for the FTSE 100, lower borrowing costs, Bank of England rate cuts, bets increase, or maybe not, given this morning's GDP numbers for November. We'll look at the earnings numbers from Whitbread, Persimmon, the house builder, Whitbread, premier and owner Whitbread, decent set of numbers. Hayes, second quarter numbers, the employment agency, don't paint a particularly pretty picture of the employment outlook. US bank earnings as well, and then of course we'll look ahead to next week and Netflix and UK unemployment, UK CPI, and what have you. So I think that's probably a fairly decent summation of what we're going to be talking about over the course of the next hour or so.
Yes, nice little running order for us.
Yeah. Okay, so let's get on to the feedback that we got from last week's podcast. A listener claimed that we were clearly very wrong to claim that the US doesn't need Venezuelan oil, and that we demonstrated a clear lack of understanding of the situation in Venezuela. I have the email in question in front of me now, and he says, hopefully you issue some clarification in the upcoming episode. Now, I've got to say, one of the key goals of this podcast, I think we can both agree, Michael, can't we, that it's to try and improve the quality of information on financial markets for our listeners.
Yeah, and educate our listeners as well.
Exactly. And obviously then it's incumbent upon us to make sure that the information that we impart is as accurate as it can be, essentially.
Yeah.
And I've spent the last sort of 20 or so years talking about markets to media pretty much across the globe. And I've always prided myself on basically making sure that everything that I try and impart is as accurate as possible. I do my research, essentially, and make sure that nothing I say can be rebutted in any way, shape or form. And I've listened back to what we said last week. I've also looked at the article in question that the listener has pointed to from the 5th of January by Gillian Ambrose in The Guardian, who I had reason to speak to over the course of the past few years in my previous role at CMC Markets, and who's a very good journalist. And I've read the article in question, and at no point does she suggest that the US needs Venezuelan oil. Furthermore, I've also talked to some good friends who worked or have worked in the oil market. And he said essentially pretty much the same thing. Nothing that we said in that podcast last week was in any way factually incorrect. Thoughts, Michael? I mean, have you listened to it back? I mean,
yeah, I stand by everything we said. To be completely honest with you, I think there's an argument as to whether the US wants Venezuelan oil. That's a completely different story. Yeah. But in terms of need, no, I don't think they do. And it comes back to the point we were making around the different blends and the different types of crude oil, and how Venezuelan crude is sour and extra heavy, which means, in other words, it is very viscous. It's very thick. It's very difficult to get out of the ground. In fact, it's so hard to get out of the ground that you need to put a thinner crude, usually naphtha, into the reservoirs and the wells that you're digging before you can get the Venezuelan crude out again. So yes, there is a lot of infrastructure that is geared up for that particular blend of crude, but it is still very expensive to produce. It's very difficult to produce. That production process is very fragile, and the US has ample commodity resources of their own, whether that be oil or natural gas at this moment in time. So I think there is, again, to reiterate the point we made last week, I think there is much more in play here than simply the Trump administration or people within the United States going, we want a few more barrels of oil.
Yeah, and as we said at the time, it's about the control of oil and denying China and Russia access to that oil rather than the fact that US refineries need it. And actually, I was looking at the Guardian website, and I found another article from a week later.
This must be the most you've ever read The Guardian in your life, I think.
by Debbie Carlson. US frackers are already facing a global oil supply glut. Trump's Venezuelan dream could make it worse. So essentially, yes, US refineries can process Venezuelan oil subject to many variables, but do they need it? The US produces 13 million barrels a day. Further supply would push prices lower. If you look at break-even levels for US frackers, we are already below $60 a barrel for WTI. So the last thing US refineries need is further erosion of their already very wafer-thin margins. Furthermore, as you rightly said, American shale fields pump light sweet crude that commands premium prices and processes very easily. Venezuela cannot export its primary product without imports. Now, that sentence or that statement captures the fundamental fragility of the industry, and those imports are subject to sanctions.
Yeah. Absolutely. And just lastly on this, because we're not going to turn this into another oil market podcast.
I've written a whole piece on this, and I've spoken to our friend Ryan, who used to trade oil. And
are you going to put that on your Substack?
I may put a link to it, because obviously I've spoken to Ryan about it, and he's essentially said that, it is, the notion that Venezuela represents some kind of oil prize waiting to be seized reflects a fundamental misunderstanding of modern energy markets and Venezuelan geology. I consider Ryan to be an expert on the oil market. And that, for me, the United States, despite having appropriate refining capacity, faces sanctions constraints that limit purchases. We've had Darren Woods of ExxonMobil saying that Venezuela is uninvestable. And they wrote, and
exactly.
and in 2007 they wrote off $17 billion of assets when Hugo Chavez seized their production capacity.
Yeah, and obviously they made those comments in remarks in that big meeting of oil CEOs with President Trump last Friday, and Trump didn't take it particularly well, effectively saying afterwards that he's probably going to cut Exxon out of the whole thing. Well, I think he's probably doing them a favour on that front, to be honest with you, because they've had their fingers burnt once or twice in that region before, and I think they'll be very, very glad to stay out of it. But yeah, I mean, what's interesting is the speed at which we've kind of moved on geopolitically from Venezuela to will Trump or won't Trump end up buying or somehow taking control of Greenland, plus all of these question marks over what's going on in the Middle East with these protests in Iran and whether you'll see any US military intervention there. So, geopolitical risk certainly isn't going away anytime soon, I don't think.
No, it's not. So, hopefully this will draw a line under the Venezuela thing. Because for me, I don't think there's anything that we need to apologise for. Maybe maybe you have a different opinion to us, but essentially that's what makes a market, sir. And as far as we're concerned, we don't resile from anything that we said in last week's podcast.
Yeah, absolutely.
Okay, so let's move on. So on the basis of that, let's go and talk about President Trump, because
well, he's been a busy boy, hasn't he?
Oh gosh, yes, give me strength. I mean, I think the idea that you can't question the president's motives with respect to Venezuela and completely criticise his motives doesn't necessarily mean you're a fan of him. I'm not, and the way he's behaving with respect to Jay Powell, it's mind-boggling. The guy's leaving in May.
Yeah, it is.
So why is why is this happening? Why not just let him go, vacate the governorship, and potentially, leave it, resign from his position as Fed governor?
Yeah,
this
and I think
will mean he's not going to do that.
Yeah, I agree. And I think this is... So just for those listeners who are unaware, if you've been living under a rock for the last week or so, the Department of Justice sent some subpoenas to the Fed on last Friday. News broke over the weekend that this had happened. Ostensibly, this investigation is around the ongoing project to renovate a number of the Fed's office buildings, including the Eccles building. That was built back in the 50s. It hasn't really been renovated since. And as with every restoration of a historical building, there have been quite a lot of cost overruns, and it's been very much delayed because that's what happens with these things. Fed Chair Powell testified on this and various other matters in front of Congress last summer, and the Department of Justice, according to their subpoenas, are investigating whether Chair Powell misled Congress. Now, I think it's important that we make absolutely no mistake here, and Powell said this himself. This investigation has absolutely nothing to do with what colour a building is being painted or how much some bricks cost, and it has absolutely everything to do with the administration trying to apply as much pressure and as much coercion as they can in order to get what they want out of the Fed, which is lower interest rates. As you rightly said, and I think it's interesting that Powell came out swinging to this, and rightly so, to defend himself. The problem for the administration is going to be in their mind, what are now the unintended consequences, which are, firstly, I think I'm with you, Chair Powell's term expires as chair in May. He can stay as a governor until January 2028. I think he's almost certain to now. I think he will view the independence of that institution as being under threat.
I would.
Probably the best way to defend against that is to stay in your job. So I think he's going to hang around, which obviously the Trump administration will not want. I think, secondly, the bar for further rate cuts, and a rate cut in January was not really on the cards after the jobs report that we had last week anyway. But the bar is probably nudged a little bit higher because the Fed don't want to be seen to kind of acquiesce and give in to that political pressure. And I think thirdly, the Trump administration have really shot themselves in the foot because, again, it's pleasing to see that those guardrails are still there. A number of senators on both sides of the aisle in Congress have said that they will not be confirming any nominees to the Fed board unless and until these legal matters are resolved. So not only is it more likely that Powell stays around until January 2028, until they resolve these issues, it's also going to be impossible for Trump to appoint his own man to the board, whether that be Kevin Hassett, Kevin Warsh, whoever. So they have massively overplayed their hand on this one. And you're absolutely right. It is 4 months today, the 15th of May, when Chair Powell's term as chair expires. You could have waited 4 months, he's gone, you get your own man in, you never have to worry about him ever again. Well, now you've actually made this problem 10 times worse for yourself.
It just beggars belief. I mean, honestly, I really don't know what's going through his mind. Sometimes playing the long game is the smart game. And
very much so.
And for me, I must admit, this has caught me, I assumed that there was some sort of plan in place when it came to essentially getting the replacement for Powell rubber stamped. Now he's made that process much more difficult. And he's also got basically politicians on both sides of the political divide lining up, questioning the wisdom of so cravenly intervening and interfering in the functions of the US central bank. And I'm actually quite pleased to see that this, he's being pushed back on, and he should be. I mean, he's behaving like a great big man, baby.
Yeah, I think you've put it very, very well there. I think I said on Monday morning he's behaving like a petulant child. I mean, that's exactly what it is. And I think actually that may be one of the reasons why markets have been able to move past this relatively rapidly, because, if you think about what protects the idea of Fed policy independence, well, you've got the legislature. They are confirming nominees to the Federal Reserve Board. The mandate that the Fed is given to them by Congress, by lawmakers on Capitol Hill. And those lawmakers have sat up and said, we do take this seriously. We are wanting to, and we see the importance of preserving that policy independence, which I think has sort of soothed some nerves among market participants. The other thing that you've got to think about in all of this is there is an ongoing Supreme Court case over whether or not President Trump has the legal ability to fire Fed Governor Lisa Cook over these allegations of mortgage fraud. Now, oral arguments in that case are due to begin on the 21st, next Wednesday. Again, if you're now going down the route of what is quite blatantly a political sham charge against Fed Chair Powell, or investigation into Fed Chair Powell, it's probably the best defence that Lisa Cook's attorneys are ever going to get given in their careers. So you've now increased the chances of her staying on the board, which again means that you're shooting yourself in the foot. So it's certainly something that we need to keep a very, very close eye on, because the erosion of policy independence. People say, the Fed, is policy independence the best thing? Well, it's better than all the other alternatives. Yeah. And to steal a line from Dario Perkins at TS Lombard, would you want Rachel Reeves setting interest rates? Absolutely not. That is why we need an independent central bank, whether it be in the UK, the US, wherever in developed markets. For the time being, it looks like we've passed that sort of peak of uncertainty and, this is actually going to get eroded. But I think Trump's going to be like a dog with a bone. I don't think this is going to go away entirely anytime soon.
No, it's not likely to. But we've said before on this podcast that while there are certainly criticisms to be made about the current monetary policy setting environment, it's the best that we have.
Yeah, and also the criticisms, and you and I have and will continue to criticise central banks as we see fit. But the good thing about that is we are making those criticisms based on the evolution of the economy and what the data is telling us. Those criticisms and the actions of those central banks do not need to be taken based out of pure political opportunism. We are arguing and debating inflation, labour markets, growth, etc., not is it the right time to cut interest rates? Oh yeah, definitely, because it's 6 weeks before an election, so let's juice things up a little bit.
Yeah.
And I would much rather live in the world we currently live in than that counterfactual.
Yeah. Okay, so basically watch this space, and based on the US economic data that we've seen so far this week, Trump is now less likely to get his rate cut than he was, say, a week ago.
Yeah, I mean, I don't think there's going to be any particular urgency from the Fed. Obviously, we had a decent-ish jobs report for December that we got last Friday. Inflation did come in a little bit softer than expected, 2.6% on the core, 2.7% on the headline. A lot of that is still skewed lower by the government shutdown, so we can't read too much into that.
Retail sales?
Jobless claims are very low, and retail sales are very solid. 11 out of the 13 categories experiencing month-on-month growth. So, certainly nothing kind of screams the Fed need to cut in January in 2.5 weeks' time, and I don't think they will. The path for the Fed funds rate is still lower. It's just a question of when they deliver that next cut, and it's certainly not going to be before March.
And one last point, obviously, on this was that Neil Kashkari of the Minneapolis Fed came out today and basically said that, irrespective of who's Fed chair, he's still got to convince the rest of the committee that a rate cut is the right place to go. So,
this is what I would call the Stephen Myron problem, which is, Steve Myron was appointed as Fed governor just before the September FOMC, come in really dovish, inflation is non-existent, the labour market's weak, we're 400 basis points and above neutral, blah, blah, blah. Fine, that's your view. You are entitled to that view. Yeah. Everyone is entitled to their view of the economy, but you are not going to be able to bring other officials along with you unless that is a clear and cogent and logical argument. And that is exactly the problem that the next Fed chair could have, whereby actually, and this is something that I'm sure we'll discuss nearer the time, you could have a situation where the Fed chair is actually voting in the minority and voting for significant rate cuts that the remainder of the committee simply do not view as appropriate. And that leaves us in a whole world of different issues.
But the issue remains the same. The Fed chair cannot carry the committee.
No, they are one of 12 votes.
Yeah.
And all of those 12 votes are equal, whether you're the chair or a governor or a regional president.
Yeah. All right. Let's move on. It was an interesting story this week about Apple. And it's something that we've sort of talked about at great length, the lack of AI innovation when it comes to Apple's products. They've just signed a deal with Alphabet.
Yeah, and I think this is interesting because obviously, we've spoken at length about how Apple have been kind of lagging badly in terms of AI development. This Apple intelligence just hasn't really seemed to go anywhere. Meta, Microsoft, Google with Gemini have just charged ahead. And I wouldn't say that Apple have kind of thrown in the towel, but I think it's a kind of pragmatic decision where they've gone, actually, do you know what? We're not going to be able to catch up if we try and do this on our own. We need to call in the cavalry, so to speak, and the cavalry is arriving in the shape of Gemini. They're
not joining the AI arms race. Essentially, what they're doing is they're going to leverage their offering off Gemini. And that's obviously given Google's or Alphabet's share price another big lift on what has already been a very spectacular performance over the course of the last 12 months. And they've eschewed OpenAI's ChatGPT. And we all know that OpenAI's ChatGPT has many questions being asked about it, certainly in terms of return on investment, shall we say.
Yes, it absolutely does. I think on the back of that rally, they may have dipped back below it, but Google did briefly trade with a $4 trillion market cap, or Alphabet, I should say, did briefly trade with a $4 trillion market cap for the first time earlier this week, becoming, I think, the third or fourth company to do so. But yeah, it is interesting how, that OpenAI and ChatGPT had that kind of first mover advantage at the back end of 2022. They were the first to the market. They were kind of what got everyone hooked on AI. I can type this into ChatGPT, et cetera, et cetera, et cetera. But now, as time has gone on, and we're into effectively year 4 now of this AI boom, for want of a better word, or bubble, some people may call it. Actually, are OpenAI losing their competitive advantage? Gemini are becoming more and more influential, not only in terms of the corporate agreements that they're doing, but the image generation from Gemini is second to none. You speak to people working in the IT space, space, and actually they are massive fans of Claude, which is obviously produced by Anthropic. Competition is increasing considerably in the space, and of course, although OpenAI are obviously a private company at this moment in time, there is some chatter they may IPO at some stage. Microsoft are a huge investor in the firm. And in direct contrast to Alphabet, the Microsoft share price is not looking especially pretty at all.
No, I mean, I think Alphabet are investing $90 billion, in obviously their AI infrastructure. But the thing is, they've got the revenue to back it up.
Yeah. And that's the key thing, isn't it?
OpenAI doesn't.
And that's the key thing. And I think we spoke about this last year, and I think it's going to become an increasing theme this year. Market participants are going to be a lot more selective around the AI theme. And there are going to be increasing questions over not only where is this capital expenditure being funded from. You look at someone like Oracle, where it's basically all coming from debt, and then compare that to Google, where it's coming from free cash flow and from sales, but also continued questions over, when are we going to see a return on this investment? They are the two big issues that continue to kind of dominate the space. But we obviously have mega cap earnings not next week but the week after, so we will keep a very, very close eye on what they have to say.
And Meta introducing more job cuts as well in
the reality labs.
10%, I think it's 10% cuts.
I think it was 10% of that unit.
I mean, it's not surprising when you consider that they've already posted $73 billion in losses on that particular division. So decisions are now starting to be made when it comes to, we can't throw all this money at the wall and hope some of it sticks. They're now starting to make hard decisions about what's working and what isn't.
And I think there's going to be a fair few more of those decisions as we move through the next 12 months or so.
Okay. Let's move on to UK markets. Record highs for the FTSE 100, lower borrowing costs, Bank of England rate cut bets increase or not, but it's not because of a strong economy, even if you take into account the fact that saw a fairly decent set of monthly GDP numbers for November. But those numbers, and I've said this on any number of occasions, monthly GDP numbers need to be taken with a little bit of salt because they can be notoriously spiky.
And that's exactly the case that we've seen this time around.
We've got the usual suspects coming out now.
I can feel my blood pressure rising already.
We've got the usual
pills or something.
Okay, the UK economy expanded by 0.3% in November, and you've got the usual suspects basically saying, this is great, Rachel Reeves this, Rachel Reeves that. We even had a certain dragon earlier this week tweeting that the fact that the FTSE 100 was at record highs was an endorsement somehow of Rachel Reeves. I mean, for God's sake, give me strength. I mean, I think I've said this before and I've said it again. One of the key goals of this podcast is to try and improve financial knowledge. But when you've got someone who really ought to know better coming up with that, I was going to say
nonsense.
That's it. Coming up with that nonsense, it makes me despair. Because if someone like an entrepreneur from Dragon's Den, I won't name her, but you can guess who it is, comes up with that nonsense, someone who ought to know better, it does make you to despair given the following that she has, to display such a level or such a lack of financial markets knowledge. And judging by the responses to that tweet, I don't think she'll be making that mistake again, but she decided to double down on a couple of occasions. I mean, what is wrong with people?
Well, quite a lot. And actually, I'll go back to the GDP in a second.
Yeah, let's do it. Yeah.
By and large, certainly in Europe, more so than in the United States, domestic equity performance is not particularly good gauge of how the domestic economy is doing. The FTSE 100, 80-odd% of revenue comes from overseas. The CAC 40 in France, it's a similar situation. The DAX is slightly different, but by and large, European markets are so heavily exposed to what's going on in the international economy. You cannot go, the CAC is at a record high, it means France is booming, or the FTSE is at a record high, it means the UK is booming. You cannot draw those conclusions. Going back to the GDP numbers that we had this morning, yes, the economy
Maybe we
did
should
grow
pin that. We need to
I think
pin
we probably
that.
should. We'll clip that as a little snippet. The economy did grow by 0.3% on a month-on-month basis in November. It is the first time that the economy has grown on a month-on-month basis since June, which I think says a lot in and of itself. And also, of course, you need to dig into the data, because pretty much the only reason why the economy did grow in November is because Jaguar Land Rover resumed production after the cyber attack that dogged them during the autumn. I think you told me a moment ago that, I've got it here actually, car production was up by 25.5% on a month-on-month basis, which drove pretty much all of that upside. If you smooth the data out a little bit using a rolling 3-month average, then the economy grew by 0.1%, just 0.1% in the September to November period. As I put on the internet this morning, that is frankly a rounding error away from stagnation. And of course, as we'll discuss in terms of the week ahead, because next week's a busy one for the UK, risks to that growth outlook tilt pretty firmly to the downside as well. So yeah, it's one of those prints that on paper it looks good. It's an upside surprise compared to consensus, but dig into the details. There is one factor driving pretty much all of it, and actually the underlying story is nowhere near as rosy as that headline might imply.
Yeah, and you've also got to price in the fact that 2 months previously car production slumped by 29.5%. So that rebound of 25.5% doesn't reverse the decline that we saw when the whole plant and the operations were shut down completely.
Yeah, you're absolutely right on that one.
So again, you cannot basically draw conclusions on the basis of 1 month of data. And I wish people would stop doing it. But ultimately, I think while I continue to do it, I will continue to call them out on it. And I don't care who...
And actually, just...
Go on.
Sorry, go on. Finish up your point. Go on.
You know, oh no, I've completely lost the thread of what I was going to say. Go on.
Sorry. I was going to say that actually, yeah, and we will do this on both sides.
Yeah, absolutely.
And we did. You know, when Jaguar Land Rover production first shut down and the economy contracted on a month-on-month basis, we all knew why it was. You know, we're not sat there going, "Oh, it's a damning indictment of the government of the day" or whatever it may be. It's just a I can't say the word, statistical quirk is what I was trying to say. You know, and sadly that is a fact of life, and that's why it's important to dig into the details, the data that we're getting. But anyway, enough of that.
But let's obviously talk also, we saw a rebound in services as well.
Yes, that is true.
And a large part of that was because tax advisors saw a big jump in accountants. I wonder why that would be in November.
Yeah, that's about the only growth industry at this point.
Tax advisors and accountants, because ahead of the budget. Well, there you go.
And then travel agents will be the next one. Home relocation services. Yeah.
Construction,
international movers.
Yeah, construction though down 1.1%. So build baby build. Well, I don't think that's going particularly well.
But well, I'm not sure it's going at all at this point.
Yeah.
And if you look at the construction PMIs, that is just utter. I mean, if you ever want to depress yourself, go and read that of an evening. It's not pretty at all. I mean, the anecdotal commentary you're getting from the construction space is basically things are as bad, if not worse, than they were during the pandemic, which says it all about the dire state of that industry. And not only in terms of housing, but also in terms of just general infrastructure in the UK, we need a strong construction sector, and it just is not happening at this point.
We do, mate. We do. Absolutely, we do. So, obviously talk of all these new projects earlier this week from the government, which is all well and good, but they don't start till 2030. So again, it's smoke and mirrors. It's aspirations. It's not spades in the ground.
Yeah, and those spades will not be going into the ground for quite some time, you would have thought as well.
Assuming they even do, because 2030, this government is not likely to be in place.
No, and that's a hell of a long way away, and we all know that there is a risk of cancellation, but anyway.
Indeed. Having said that, I mean, it's not all doom and gloom in the construction sector. Persimmon posted its Q4 numbers earlier this week, and despite a little bit of a drop-off in the wake of those numbers, we've seen a fairly decent rebound today, so they're still very much in the uptrend they've been in since they posted their August lows. And consequently, I think the markets... are fairly optimistic about the outlook for when it comes to Persimmon share price. We haven't seen it drop below their December lows, despite the big falls that we saw in the last couple of days. We've seen a rebound today. Completions are pretty healthy, as well as their average selling prices.
Yeah, and I think very much bucking the trend of that pessimism that we were just mentioning around the construction space. I mean, you go through the figures from Persimmon, completions were ahead of where the market wanted them to be. The order book's growing. Profit is expected to come in right at the top end of expectations, and they expect profits to rise by somewhere between 20 and 30 million next year. So billion would be nice.
It would be, wouldn't it?
Million with an M. Let me get that right. Million into 2026. So yeah, things do seem to be moving in the right direction for the firm, which is definitely contrary to the broader sector, it must be said.
Yeah, absolutely. But again, these numbers have to be treated on a quarter by quarter basis. I read this morning that credit card delinquencies are up, but obviously the lower borrowing costs that we've seen in UK gilt markets would suggest that home demand may start to pick up, assuming that obviously we see more rate cuts from the Bank of England later this year.
Yes, which I'm sure we'll get onto in a bit when we start talking about inflation and things like that.
One sort of little concern was that operating margins were expected to come in at the lower end of their 14.2% to 14.5% range, even as they upgraded their profit forecasts for 2026. So
worth keeping an eye on.
Something to bear in mind. But certainly, I think a fairly upbeat set of numbers from Persimmon, but we haven't really pushed above the highs that we saw in the middle of 2025. We've come back below them. So that £14 level still remains a very, very key level when it comes to further gains for the Persimmon share price. So it's worth keeping an eye out for that.
Indeed.
Also got a decent set of numbers from Whitbread, Premier Inn.
Yes.
We talked about a high bar for them, I think. They posted some fairly decent numbers. Revenue per room up 3% in the UK, up 7% in Germany. And guidance was also fairly positive as well.
Yeah, I think the guidance was probably the key point from the firm, because obviously, one or two things that we've been looking very closely at are, firstly, there's been a lot of talk around business rates. What's the hit from the changes to business rates going to be?
Well, we still don't know that, do we? Because they're U-turning on that.
Well, they are U-turning on it, but having said that, Whitbread have come out and said it's the current way that it's going to be structured, the hit is going to be less than they first thought.
Yeah.
You would argue that if there is another U-turn, then the hit is going to be even lower than those new expectations, if that makes sense. So that's a positive. And they've also increased their guidance around cost savings this year as well, which, again, the market has taken as a positive too, along with that pretty resilient sales and revenue growth that you just mentioned.
Yeah, in the 6 weeks to the 8th of January, total UK accommodation sales were up by 4%. I was part of that 4%.
Well, there we go. You've propped up the whole quarter, mate. Well done.
While in Germany, sales are up by 11%. So obviously,
were you part of that 11% as well?
Not in Germany. No, they did that themselves, all by themselves. But it's a much smaller notional market in Germany. It's the market's in its infancy. There, it's a very much lower proportion of their overall revenue. But certainly, I think what we've seen from Whitbread, fairly decent share price reaction from the lows back in December. Price is just below its 200-day moving average. I'd like to see it get back above that.
And that could then really start to give it a bit of a kick higher, I think.
Kick higher back to the levels that we saw back in October when it was above £32. At the moment, it's just around 28. So certainly could do with a little bit of a boost in the share price. So it does appear to suggest that companies are adapting to rising costs. They're adapting to maintain their margins. But of course, the end result of that is what we're going to come to when we talk about next week, higher levels of unemployment.
Well, exactly. There is only a finite amount of cash that goes round, and yes, fine, you can adjust to those higher costs, but you either absorb them in the form of lower margins, which no one particularly wants to do. You pass them on in the form of higher prices, which results in inflation, or you trim your headcount or cut earnings growth, which is, again, another factor that the companies can, another lever, I should say, that companies can and are pulling. So, yeah, there's a degree of adaptation going on, but you would argue in an ideal world that you'd just rather you didn't have to adapt at all.
Yeah. On the topic of unemployment or employment, let's move on to Hayes' second quarter numbers. If you thought things couldn't get much worse for Hayes, with the shares already at multi-year lows, you'd be wrong, because they've fallen even more over the course of the last 3 days. I mean, it's not just here in the UK that labour markets are struggling, to be fair. Germany saw the biggest fall with a 14% fall in like-for-like net fee performance. The UK saw a 9% decline. With total fees seeing a 10% like-for-like decline, and permanent roles bore the brunt of that.
Yeah, and to be honest, I mean, the report is pretty damn ugly, if we're being completely frank. But I would also say it probably shouldn't be a particular surprise to anyone. We've spent months and months, if not years now, talking, as you said, about the sluggish nature of the labour market here in the UK. We've just come through, what is it now, 12 of the last 13 months, I think, where we've actually shed jobs on net here in the UK. Things are not much better in the Eurozone. We're talking about no hiring and no firing in the States, people just hoarding the workers that they've got, not bringing on new staff. And then on top of all of that, you've got this whole issue of, well, actually, do we need people, because can AI do the job instead, which is now another headwind for the recruitment sector to grapple with. So, I can't say I'm especially staggered or flabbergasted by the downbeat numbers that they've posted. What I would say is probably more worrying is you can't really see any point that this actually materially starts to turn around.
Oh, I think that's the worry, and I'd like to be wrong. I really would. But
yeah, so would I, to be clear.
Hayes went on to say it expects to incur a £10 million restructuring charge in first half, as well as looking to secure £15 million in further cost savings towards a target of £80 million by 2028. Even with all of that,
which is fine. And you can restructure the problem that they've got is you can restructure the business as much as you like. If people aren't recruiting, doesn't matter what your structure looks like. You're not going to make any fee income.
No, exactly that.
All the restructure is doing is incurring costs that arguably you can't afford.
Well, exactly. And people aren't going to basically hire for permanent roles. They're going to hire for temp and contracting roles. And certainly in the contracting part of the business, that was performing slightly better. But even there, they saw an 8% decline in net fee revenue. So, for me, it's going to be very, very difficult for these sorts of companies. And obviously there's Robert Walters as well. It's going to be very difficult for these companies to compete at a time when ultimately the labour market shows increasing signs of shedding more jobs.
Yeah, no, I fully agree with you, mate. I think, you need to see signs of a sustained and sustainable turnaround in the labour market before you can be bullish on those names. And right now, sadly, we're not seeing it. Hopefully we do, but our expectations are low.
Okay, so let's look at US banks. Pretty much across the board, a really decent set of numbers. You wouldn't know it from the share price reaction. And I suspect a large part of the reason for that is what Trump said at the weekend about credit card fees.
Yep, I make you absolutely right. We probably don't have time to go through all the individual results because
we don't. But I mean, there's a broad brush approach.
Yeah,
they're all good.
Absolutely. They were all very, very good. Trading revenues, very, very strong. Goldman Equities trading revenue was a record quarter, beating their own Q2 record. And bear in mind what happened in Q2. That is absolutely staggering that they managed to beat that. By and large, things have gone really, really well. The problem for the banks, and I'm going to take Goldman out of this here because they don't have a credit card business, but the problem with the banks, by and large, is this idea from President Trump that has gathered quite a lot of traction that he wants a cap on credit card interest rates at 10%, effective from, I think it's the 20th or the 21st of Jan for the next year. Obviously, that is going to be very, very problematic from the bank's perspective because, well, one, they make a lot of money in terms of credit card interest margins, but two, I think it's going to be troubling from a macroeconomic perspective as well. It's not entirely clear how or indeed if this is going to happen yet. However, the obvious response from the banks to this will simply be to extend less credit, because the banks will turn around and say, well, actually, we are not comfortable extending the same amount of credit to riskier borrowers, those with lower credit scores, if we can't charge a higher interest rate in order to compensate for the risk of us lending that money to you. They will then pull credit lines, and as a result of that, you have a de facto monetary tightening, which is akin to the Fed hiking rates, essentially, because you're contracting the supply of credit and money in the system. So I totally understand why the Trump administration thought this is a good idea, it's going to grab some headlines. But going back to what we were saying around the issues with Fed Chair Powell and the DOJ, it's the unintended consequences. Great. You've got your headline that says credit card interest rates are capped at 10%. And let's be honest, no one's going to cry for the banks over this one. But what they are probably going to cry about is when they go to the bank and then Bank of America or Citi turn around and go, your 10 grand credit limit is now 1 grand.
Computer says no.
Be a problem. And that is going to be a big problem.
Yeah, it's the old computer says no.
Yeah, exactly that. So we'll see how that one shakes out. Obviously, if it does come to fruition, it's going to be a pretty big structural headwind for the banks. And I agree. That's the reason why we've seen them all come lower on the back of earnings. The figures themselves are great. And actually, if you didn't have this credit card cap doing the rounds, then all the banks probably be up 5 or 10% this week.
Yeah, I mean, I'm looking at the lower. Bank of America posted lower than expected provision for credit losses, and I think that was pretty much similar in terms of Wells Fargo. I'm not sure, and maybe JP Morgan.
Well, JP Morgan's was slightly higher, but that was technical because they've taken on the Apple credit card.
Yeah.
So that wasn't really them being worried about anything. It's just that they've expanded their business.
So you would do that anyway.
Exactly.
But I think it's the right idea in terms of stopping banks from ripping people off. I just think 10% is too low. I think maybe 20%, because all you're going to do is you're going to drive these people into the clutches of people like Klarna and the buy now, pay later, which I think is a bubble waiting to burst.
Yeah, and also it's a considerably riskier way of borrowing than with the banks or with the credit card providers. And I fully agree with you. I think, it's a rushed and ill thought through move with noble aims. Let's just go back to the drawing board, get the bank CEOs around a table, get Congress involved, and actually come up with a number that is kind of fair and agreeable to all sides of that equation, rather than going down this route, which is actually, as we've just discussed, probably going to have the opposite effect of the one you want.
Drive out the cowboys, because obviously there are cowboys out there who charge exorbitant levels of interest rates.
And you're driving people towards them, sadly, by doing this.
You are. Okay, so let's move on to next week.
Busy one.
Busy one. Okay, let's quickly blast through these. We got UK wages and unemployment for November. We've got UK CPI for December, the 20th and the 21st. Now, obviously, the recent November numbers gave the Bank of England cover to cut rates to 3.75% after the sharp slowdown to 3.2. Bank of England Governor Andrew Bailey was the swing voter for that vote. What do we think is going to happen in December, Michael, for inflation?
I think it's probably going to be more of the same, just a continued sort of gradual downward path of headline core and services prices. But I don't think it's going to be enough of a move lower to force the bank into delivering another cut as soon as the February meeting. Of course, as you said, it was a 5-4 vote. Bailey was the swing voter. Bailey himself in December was talking about maybe slowing down the pace of policy easing. So I think you really need a very, very cool print indeed, low twos, which just isn't going to happen to get the bank even thinking about a cut in February. So I guess the way I would be looking at it is,
do you think they're behind the curve?
I think they're so far behind the curve they can't see the bloody thing.
So you think that they should cut rates?
I think bank rates should be at 3 right now.
Right now,
we've got an economy that
what's
has
your
not
name?
Grown.
Michael Trump.
No, he'd say 1. But no, in all seriousness, we've got an economy that, fine, we grew in November, but it's mechanical. By and large, we've not had any proper economic growth since the summer. inflation is now on a path back to the 2% target, and it will probably get there in the middle of this year and stay around that level.
So you put bank rate below CPI?
I would. Yeah, I'd be comfortable doing that.
But
because
how would you explain that?
Well, I'm not saying you cut 75 basis points at one meeting. You can't do that now. That looks ridiculous. So by the time you've cut 25 in, what would it be, February, March, and then April, you get bank rate to 3, inflation's at 2 in April, or 2.5. So actually, you would still have a positive real bank rate. There's my get out clause. But just to add to that,
you nearly walked into that one.
Inflation is on its way lower. I think the risks of persistence have decreased considerably because not only have you got unemployment at a post-COVID high, but also private sector earnings growth is barely at 3%. So I think the bank are massively making a policy error here. But again, just an important point, I'm not on the MPC, at risk of stating the obvious.
Well, we know
what I think the bank should do doesn't matter. It's what they will do that matters, and what they will do that the pound and gilts are going to trade on the back of. And we can all have our own views.
Yeah, and what the markets think they will do.
Exactly, yeah.
Because obviously, if you look at other measures of inflation, we're well above 4.
Yeah.
And public sector wages.
Well, yeah, we really haven't got time to get into public sector wages.
Okay.
We'll do that when we've got the data next week. We can have a rant about that one.
Obviously, we've got wages and unemployment for November. So you expecting to see a little bit of a slowdown there, and unemployment 5.1 or maybe even higher?
Well, yeah, I think the risks are certainly to the upside towards unemployment continuing to rise. The number to watch is 5.3. That was the high that we saw in the pandemic, and sadly, I think we're going to take that out this year and maybe even get to 6, worryingly.
Yeah, well, we didn't have all that business eat out to help out and all of that back then. So there'll be no buffer, there'll be no cushion for businesses. We've also got UK retail sales for December.
We do.
Could we see a rebound, Michael? I think based on some of the updates that we've seen from the big retailers, there's a good chance that we might, almost like a last hurrah. Basically, people have taken the view that, oh, God, it's been so bloody miserable in October and November. We're determined to enjoy Christmas and the New Year. So let's just go out and splurge.
Yeah, I would be inclined to agree with you on that one. And I think the important takeaway for me from the retail earnings, and we discussed this in last week's podcast, if people haven't heard it, is it was quite a broad-based increase in spending. It was staples, but it was also discretionary items. You think about how well Next did during the quarter, for example. I think you could see, and Premier Inn and Whitbread, as we just mentioned. Yeah. I think we could see a pretty decent print in December, or at least a positive print in December. Positive, we can get these days. But then that, as you say, is probably a bit of a last hurrah, and then we're in for a subdued start to the year. Obviously, the other thing that could lift December is we were after the budget. So although the outcome of the budget wasn't exactly positive, there's some certainty around it at the very least.
Okay, let's move on. Bank of Japan. Is it the Bank of Japan next week? It was on a question mark on the calendar, so I wasn't sure whether or not they were actually going to do it. And obviously, we've now got the new Prime Minister potentially calling in an election.
Yes, well, actually, it's funny you mentioned that because the Bank of Japan meet next Friday and they are going to keep rates unchanged.
Okay.
The Diet, which is the Japanese Parliament, also meets for the first time this year next Friday and is going to be dissolved immediately in order to call an election. So that is the main focus in Japan at this point. I think the BOJ are on the sidelines until the spring at the absolute earliest.
Even with the weak yen?
Even with the weak yen. I think the BOJ will want to see the results of the way Japan works. They have these big unionized negotiations in terms of wages every spring. I think the BOJ will want to see the results of that in terms of how much earnings are going to be growing by before they then decide whether or when to pull the trigger on another rate hike. The yen is weakening considerably. If they want to prop that up, that's a decision for the Ministry of Finance to intervene monetarily that way, not for the BOJ.
I think it's worth keeping an eye on JGBs in terms of yield as well, because we talked about that in the last podcast of last year about the potential risks that potential gains in JGB yields could cause a little bit of capital rotation into Japan and out of other global bond markets.
Yes, indeed.
Okay, we've got retails, JD Sports, Q4 numbers on the 21st. Seen a modest rebound in the share price there. They've been struggling a little bit because of the fact that their US operation, they're having to absorb an awful lot of what I would call restructuring costs as they try and grow that US business and integrate it into their business model. We've seen a fairly decent rebound off the lows in November, but it's been fairly weak. It's a difficult one, I think, this one, because we're slap bang in the middle of the trading range we've been in since June.
Yeah, it's not a great one. I mean, you would say that sort of tailwinds from the broader retail space could be a bit of a boost, but again, they've got all of those restructuring costs to deal with. So, I don't think the earnings is going to be enough of a catalyst to see us break out of that range. Let's put it that way.
JD Witherspoon's second quarter numbers on the 21st of Jan. I was scratching my head in November because the weakness in the Witherspoon share price belied the strong performance that we've been seeing pretty much since those July peaks. Someone must have heard me, because we bounced off 600p. We're now at 760p and just below the highs that we saw in July. And I think that's essentially where it should be. The business is a strong one. There's been much discussion about business rates. But despite all of the increases in costs that the hospitality sector has had to endure, Witherspoons has stood out like a beacon in a very, very bleak landscape. 3.7% increase in like-for-like sales in Q1. Bar sales rising 5.7 and food 0.9. The big question is, can they sustain that going into Q2? Obviously, that's the Christmas period, New Year period. I think they probably can.
I think they probably can as well. I think they're, we've said a number of times, they are a really, really solid business. And you would expect that those festive tailwinds are a decent helping hand to them as well.
It'll be interesting to see what Tim Martin has to say, given post-budget. He said he was cautious about the outlook given the recent budget. So it'll be interesting to see what he has to say now. And it was interesting that earlier this month, Tesco CEO Ken Murphy basically backed Tim Martin up when he said the business rates framework really needs to be rethought.
And it does. And Tim Martin is never backwards in coming forward. So I'm sure he'll have some interesting comments on that front.
OK, so we've also got B&M European Retail. Their share price has been an absolute car crash of late, pretty much since that profit warning in November. Hasn't really done an awful lot. But you've got to ask yourself, how much lower can it really go? It's a budget retailer. It should do well in the current environment. The share price performance belies that fact.
Yes, and the other thing with that is you've got to ask, have they got all of the bad news out the way already by issuing that profit warning, meaning that actually they could be doing a little bit of a cunning ploy whereby when they drop earnings, they're not as bad as the market's expecting because they've already braced us for a hell of a lot of bad news.
Finishing up, there's only one real company. Well, there's plenty of, earnings season is now underway in the US. The one I've picked out is Netflix. Now, fourth quarter numbers. Now, in October, I posed the question to you. Do you remember, have we hit peak Netflix?
You did, yes.
And I suggested we might have. And certainly the share price performance since then suggests that we have.
Yeah, and I think you're probably right with that one, to be honest. The share price has been very, very lackluster indeed. It does increasingly look as if they are struggling to expand their user base or their subscriber base. And of course, now the market has got to worry about how Netflix is going to find the cash to buy Warner Brothers Discovery. Which is another thing that the market's obviously got sort of on its mind as well.
Assuming the deal goes ahead.
Well, yeah, assuming it goes through, which obviously is yet to be seen. You've got Paramount Skydance involved as well. But yeah, it's going to be interesting to see what they say. The market, incidentally, is pricing, if you look at options, a pretty punchy move of about 8%, either up or down in the day following that earnings report. So going to be interesting to keep an eye on that one, I think.
Right, that's due on the 20th. Let's look at what they expect to see. $45.1 billion in 4-year revenue at the top end of its forecast. It raised its forecast for on cash flow. The company raised its forecast for 2025 to $9 billion, as well as maintaining the share buyback program. One thing it's important to acknowledge here, that with all this noise about Paramount Skydance and everything else, there's a $5 billion break fee in this deal with Warner Brothers Discovery if it doesn't go ahead. So the risks here are very much of a price tag of $5 billion if this deal doesn't go through. So the stakes are high.
They are very high indeed, and I think market participants are going to be watching this report very, very closely indeed, because not only are Netflix operating in an environment with increasing headwinds, as we just said, they're also kind of bringing risk upon themselves with this M&A business. So, yeah, plenty of moving parts in that one.
Yeah, Q4 revenues are expected to come in just under 12 billion, helped by the return of Stranger Things, which I have to say was pretty good. I've got to say, I enjoyed it. Operating margins, though, are under pressure. They're going to fall further to 23.9% in Q4. So, you know, it's going to be interesting in terms of how they finish the year, but also what their expectations are for fiscal year 2026.
Yes, indeed.
Okay, so that pretty much summarises, I think, everything that we needed to talk about with respect to the podcast. We've come in pretty much on the hour. Yeah, watch this space, and hopefully we'll be able to dissect all of the numbers, unemployment, CPI, Netflix earnings, and pretty much everything else, as well as any further Trump grenades. This time, same place next week. But once again, thanks a lot for your company, Michael. It's been a pleasure.
Indeed, mate. See you next week. Bye-bye.
Cheers, bye.